G'day everyone. Look, the rules for superannuation in Australia are about to get a major shake-up. And if you've got a decent-sized self-managed super fund, you're going to want to pay close attention. There's a new tax coming. It's called Division 296. And today, we're going to break down exactly what you need to know to get your game plan sorted.
So here's what we'll cover. We'll look at what this new tax is all about. Then we'll dive into how it's actually calculated. We'll tackle the big one, the unrealized gains problem. We'll also talk through some of the strategies being discussed to navigate the new rules. And finally, we'll wrap up with a really practical pre-game checklist for you.
All right, let's jump straight in. First up, what on earth is this new tax? And, why is it even happening?
Okay, $3 million. This is the magic number you need to burn into your brain. Starting from the 1st of July 2025, if your total super balance tips over that $3 million mark on June 30th, well, this new tax is going to kick in for you, and it's a hard line in the sand. What's really crucial here is that this threshold isn't indexed, which means it doesn't go up with inflation. So over time, a lot more people are probably going to get caught in this net.
Now, it's really important to get your head around how this actually works. This isn't a replacement for the 15% tax your fund already pays on its earnings. Nope. This is an extra 15% tax that gets slapped on top, and it only applies to the earnings from the part of your balance that's over $3 million. So for that chunk of your super, the tax rate effectively doubles. We're talking 30%. Ouch.
So you might be asking, why are they doing this? Well, the government's official line is all about fairness and making the system sustainable. Their argument is basically that the tax breaks for people with really large super balances are just too generous, and this new tax is their way of trying to level the playing field a bit.
But, and this is a big but, the tax and accounting world is really pushing back on one key point. And this is the real heart of the controversy. This tax is based on unrealized gains, paper profits. As the Tax Institute points out, this means you could be paying tax on money you haven't actually got in your pocket. Money that, if the market tanks, you might never see. This is the absolute core of the debate, and it's a game changer.
Okay, let's get into the nitty-gritty, how they actually calculate this thing. Look, I'll be honest, the formula can look a bit scary at first glance, but don't worry, we're going to walk through it step by step, and you'll see it's actually pretty logical when you break it down.
So, first things first, the whole calculation hinges on something called your total superannuation balance, or TSB. This is basically the grand total of every single dollar you have in super. That includes your SMSF, any old industry or retail funds you've got lying around, all of it, added up on June 30th each year. If that number is under $3 million on the day, you can breathe easy. You're in the clear for that year.
Right, so here's the four-step process the tax office will follow. First, they come up with this special number called superannuation earnings. We'll get to that in a sec. Second, they figure out what slice of your total balance is sitting above that $3 million threshold. Third, they apply that slice, that percentage, to your earnings to find the bit that's actually taxable. And finally, step 4, they hit that amount with the 15% tax. Simple, right?
Now, this next bit is probably the most important part to understand. Because earnings doesn't mean what you think it means. It's not your fund's profit for the year. The ATO has its own special formula. Basically, they look at the change in your super's value over the year. They take your closing balance, add back anything you withdrew, take away anything you put in, and then subtract what you started with. That final number, that's what they call earnings. Okay, let's put some real numbers to this using an example from the Treasury. Let's talk about Jess. She starts the year with $4 million in super. By the end of the year, it's grown to $4.5 million. After they adjust for her contributions, her superannuation earnings for the year are calculated at just over $476,000. Now, her final balance is $4.5 million, right? The portion over the $3 million threshold is $1.5 million, which is exactly 1/3 of her total balance. So they only tax 1/3 of her earnings. That taxable amount comes to about $159,000. And 15% of that? It's a tax bill for Jess of just under $24,000. And that's how it works.
All right, so we've got the how. Now let's talk about the why this is so controversial. We're about to get into the really tricky part of this whole thing. The one issue that's got every SMSF trustee and advisors seriously worried.
So, why is everyone up in arms about taxing paper profits? What's the big deal, especially for SMSFs? Well, it really comes down to two simple things: cash flow and whether it's actually fair.
Here's the best way to think about it. Imagine your family home goes up in value by, say, $100,000 this year. You haven't sold it, you haven't seen a cent of that money, it's just worth more on paper. Now imagine the government sends you a tax bill for that $100,000 increase.
That's exactly what this tax does inside your super. You're paying real tax on money that only exists on a valuation report. And this is where it gets particularly dicey for self-managed funds. You see, the big industry and retail funds, they're full of shares and cash, stuff they can sell in a heartbeat. But SMSFs? So many of them hold big, lumpy, illiquid assets. Think about it. A single commercial property is a classic example. If that property gets revalued and goes up in value, boom, you get a tax bill. But where does the cash to pay that bill come from? You can't just sell a few bricks. You might be forced to sell an asset you plan to hold for decades, or to pay tax on a gain you haven't even realized.
And we're not talking about small amounts here. The potential impact is huge. Early analysis from the software provider Classist suggests that the tax hit, just for the SMSF sector, could be around $2.7 billion. That's actually more than what the Treasury initially predicted for the entire super system. When you break that down, it could mean an average tax bill of over $50,000 a year for those affected. That's a serious number.
And that brings us right back to the cash flow problem, what the experts are calling a liquidity crunch. That same report estimates that almost 7% of the SMSFs hit by this tax simply won't have enough cash in the bank to pay the bill. Think about that. That means thousands of trustees could be forced into selling assets, maybe at the bottom of the market, not for any investment reason, but just to find the cash to pay the tax office.
Okay, so that's the lay of the land, and those are the big challenges. Now let's switch gears and talk about strategy. What are the conversations you need to start having? And I have to be really clear here. This is not financial advice. This is just a roundup of what the experts are talking about. You absolutely need to get advice that's tailored to your own personal situation.
Really, the massive decision for anyone over the threshold is this. Do you keep the money in super and just wear the new tax? Or do you pull the excess amount out and invest it somewhere else? It's a really complex trade-off. Outside super, your capital gains tax might be higher, but you only pay it when you actually sell. With this new rule, you're paying tax on the growth every single year, even if you don't sell. It's a massive strategic choice.
So, one school of thought is to manage your balance inside the super system. For example, since the tax is applied per person, not per couple, equalizing balances between spouses is a big one. Or if you're old enough to access your super, maybe you make a tactical withdrawal right before the end of the financial year to sneak back under that $3 million line. And a non-negotiable, getting your asset valuations right. They have to be accurate and defendable, because you can bet the ATO will be looking very closely.
The other main strategy being discussed is taking that money over $3 million and putting it into a different structure altogether outside of super. And one vehicle that keeps coming up in these conversations with financial advisors is the investment bond.
So why investment bonds? Well, they're kind of like a tax-paid investment that sits completely outside the super rules. The earnings inside the bond are taxed at 30%. But here's the kicker. If you hold it for 10 years, you can pull all the money out, including all the growth, completely tax-free. So for long-term investors, it's being looked at as a serious alternative to copying that new tax on paper profits every single year inside super.
Okay, we've gone through the new rules, the big risks, and some of the strategies floating around. Let's bring it all home with the super practical checklist, your next moves.
Right, here's your 5-point pregame checklist. Number 1, the first, most important question, can you legally get your money out? Check if you've met a condition of release. Number 2, get your valuations sorted. Make sure they're accurate, documented, and up to date. Do it now. Number 3, work out a liquidity plan. If you got a tax bill tomorrow, how would you pay it? Have a plan. Number 4, review your whole strategy. Does this change your investment plans, your estate planning? And number 5, and honestly this is the most critical one, book an appointment with your financial advisor or your accountant. This is way too complex to try and figure out on your own.
Look, at the end of the day, Division 296 is a massive change to the super landscape. So I'll leave you with this question to think about. You've put in the hard work to manage your own retirement savings. The question now is your strategy ready for a whole new set of rules?